morning, everyone. Hope you all had a great weekend. I want to start with, there's a Beta Alpha Psi event on Wednesday afternoon, public speaking. Shouldn't come as a surprise to you. I'm a big proponent of this. This is an individual from the Writing Center who's going to be talking about tips and strategies for both kind of the whole lifetime of public speaking, from preparing, delivery, that good stuff. So, well worth your time. And as I told you before, the more you do this, the better you get at it. It is a learned skill. No one is born being a good public speaker. It's practice that one can do. So, probably well worth your time to hear what this individual has to say and how they dealt with this particular aspect of this. And again, I'll reiterate, it's one of those things, if this is an uneasy thing for you to do, that might be an indication of something you need to work on. Okay? And just think, as a professional, you're going to have things you do really well, things you need to work on. But if you get the things you need to work on and you work on them, you elevate them a little bit, you don't have to be the best in the world, but just elevate them up. Just think how much easier your professional life is going to be. So, okay, we're going to continue on with chapter 8. And we're on planning, and we're around slide 43. Okay. Hey, has anybody had a supply chain management class? Just curious. Okay, so about almost half. So again, this is I'm assuming in that course or courses that you studied, there was some transformation going on with the business and from an operational side, trying to become more efficient. Did you guys did they mention tax at all? I'm just curious.
Not really. It's more like bottleneck, obsolescence,
Yes.
like inventory, stuff like that.
Okay. And completely fair, right? But one aspect of being efficient in your supply chain is being tax efficient in your supply chain. So I'm sure in addressing those things that Connor was mentioning, there's restructuring of the business, right? And from a tax planning perspective, that's a perfect opportunity to insert yourself as a tax practitioner to try to drive value into the company. Because as business is moving and changing, if you could just influence it a little bit, you can get a better tax answer. And as I mentioned last week, the folks that are leading these projects on supply chain, it's not tax, right? It's the operational side. But if you introduce some tax savings to that, they will count that as the overall project savings as they're espousing this to management and reasons for them to move. So what we talked about last time was from a tax perspective, the key aspects of the supply chain is the types and location of the entities involved, which typically you can have a lot of influence as a tax person, because operations doesn't necessarily care the type of legal entity. They're not all focused on that. And the location of the entities, you might have some influence, but not ultimate say-so as to where that is. But if they're considering 2 or 3 different locations for particular entities, if you can steer them in a direction that gives a better tax answer, again, better for the overall project. And then the contractual arrangements amongst the entities. That ability to influence where profits reside throughout a supply chain is going to drive where the tax results are located. And transfer pricing is something we always have to think about in this. They have to deal with that on the accounting side as well. They can't just move profits willy-nilly around the supply chain. It has to be based on risk and responsibilities within the supply chain, and you can paper that with your contractual arrangements amongst the entities to a large extent. So many U.S. companies have done this in the past or revisit this periodically, again, to deal with any issues in the supply chain. The tariff noise coming out of our administration drives a bunch of that. Back when I was practicing, the rage was to move your supply chain and your management of offshore locations and tax advantage locations. lowering your tax burden. We've got tax changes we're going to talk about in a moment that we've discussed in the past. We're going to revisit that limit the ability to do that. Plus, we have an administration who is trying to incentivize doing that stuff in the United States. So many companies have revisited their supply chains and said, okay, one, we had the pandemic, we had supply chain shocks and difficulty getting things through the system. And two, we have the Trump administration who is incentivizing doing things in the United States and making it costly to do things outside the United States via tariffs that can be imposed on the flow of goods. So the restructurings that you see typically around the centralized management of production, distribution, support services, and research activities. So that ability to kind of have centers of excellence drives cost savings, right? Because you're going to be a more lean and efficient organization. If you can, and that centralization of activities is what's going to attract profits, right? Your centers of excellence around the world are going to attract the profits in the supply chain. So the restructurings often involve creating regional principal companies. Principals are the ones where they manage specific roles in the organization on a broader sense. So you might have research centers, you might have tech centers, IT centers, you might have research centers, you might have management of Europe, those types of things centralized in a particular location. That may also involve the centralizing ownership of intangible property. So your intangible assets, many times for large companies, that's the most valuable assets in the company. Where are those owned? Where are those developed? Where is the next generation of intellectual property created? Again, where those are owned and exploited is where the profits draw from the global operation. Centralizing R&D activities in research centers, we're going to put the white lab coats that are doing all the research, right? Now, I have to put those in the location where I have the best employees, right? That's important as well. But if I can match that with a low tax jurisdiction, all the better. Converting manufacturing and distribution subsidiaries into limited risk operations. Okay, your manufacturing centers might be in your highest tax jurisdictions. If you have a manufacturing company that's located in Germany, because that's where you're in the car industry and that's centralized in Europe, in Germany, that's a high tax jurisdiction. So can you do your manufacturing on a limited risk basis? What that means is all they do is what they are told to do, right? You might have a regional management operation outside of Germany that tells the manufacturing company, do this, like this, at this point in time. No true independent thought in the manufacturing location. What you're trying to do there is limit the responsibilities in that location, trying to limit the profits in those locations. Okay? You could do the same thing on sales subsidiaries, distribution subsidiaries. You're going to sell this product at this price on these terms. Not a lot of decision making in those locations. You have a distribution center in France. France is another high tax jurisdiction. You want to limit your profits there. If the people in France only do what the regional holding company or regional principal company tells them to do, you can limit the profit that you earn in France and earn it elsewhere in a more tax advantageous location. Centralizing support services and shared services centers. These are more in your back office operations. Maybe you could do that in a lower cost environment or a lower tax environment as well. But these can be your back office accounting, your back office treasury functions, those types of things that just have to be done on a global basis, but maybe you can centralize that in a particular location. By centralizing your key activities, you can streamline your operations and create economies of scale and also drive tax savings if you have your tax people involved. So if you guys go into supply chain or operations, don't be afraid to invite your tax people to the table. They might be able to make the project even better. Okay? And if you're a tax person, don't be afraid to ask if you can join those meetings. You hear them talking about it, you see it in a company newsletter. Hey, do we have tax representation? I'd like to volunteer to sit in on those meetings. Okay? The following roles are typical in a tax efficient supply chain. that principal company. They typically own, they can own the high value intangible assets. They direct business planning and strategy. They oversee development, production, and sale of goods and services. So this is kind of your headquarters company, but maybe for a regional basis. So if you're working for a US multinational, the global headquarters are going to be in the United States. But how do you run Europe? You might have a CEO of Europe, a country manager that runs that region. You might have a regional headquarters in Asia. That might be in Hong Kong. That might be in Singapore. Those types of locations is where you centralize those types of high value added services. That's going to attract the profit in the supply chain. You can have your limited risk manufacturers all around the world. So you might have to, you might do your manufacturing in certain locations just because it's more efficient from the product flow. So China's obviously a manufacturing center for most of the world. So you might have limited risk manufacturing in China. Again, limited risk. Do what you're told from the principal company. They direct what to make, when to make it, how to make it, all that. Limited risk distributors, same thing, but on the sales side, right? You might have multiple of those all over the country, trying to skinny down the profit there. That all you do is you acquire the goods and you resell them to customers in your location. But the management of all of that activity is done on a regional basis. If you do that, and you centralize your profits in the principal company, the question becomes, where do you place the principal? That's going to be where the majority of the profits are outside the United States. If you can, Switzerland has been historically a very, very popular place to do this. Many U.S. multinationals have their European headquarters in Switzerland for several reasons. One, Switzerland can give you a lower tax rate. So you're generating profits in a low tax jurisdiction. That's the best planning you can ever do, right? The other reason is typically they will send their U.S. executives through a tour and work for a year or two in the Swiss headquarters. It's very popular for U.S. multinationals to spend some time in Switzerland. They'll move their families there. They get to see the rest of the business. They get to run things, and then they come back to the U.S. headquarters office. Easy to get to, educated workforce, business-friendly environment. Okay? Other principal locations that are popular, Luxembourg's very popular. If you're heavy into Asia Pac in your business, then you'll see Hong Kong. Singapore is very popular. Again, for similar type of reasons. Friendly from a tax perspective, highly educated workforce, and you can get U.S. people to move there for a particular period. Okay. So that's tax efficient supply chain. Keep in mind, okay, this is an important thing. Pre-GILTI, pre-net CFC tested income, which is what we have going forward from 2026 going forward, we used to drive a lot of tax advantages because if I could get my principal company tax rate to say 7, 8, 10%, something like that, my incremental benefit was the difference between that and 35%, which was my corporate tax rate in the United States before Trump 1.0 in 2017, election of 2017. Since then, we've narrowed that gap, lessening the amount of tax savings that I can have. As you know, from the net CFC tested income regime, if you have a tax rate in your foreign operations of at least 14%, you shouldn't have incremental U.S. tax. Because we can claim a full foreign tax credit to offset that residual tax, meaning that if I pay tax at 14% in my foreign location, I can save up to 21%. So I get 7% is the maximum tax savings I can. If I pay less than 14%, the U.S. is going to, the operation of the NCTI regime is going to bump it up to 14%. Okay? If I pay more than 14% in my foreign principal location, then that's just extra tax that I'm paying. I don't get any benefit for that because that'll be excess credits in the United States. So the maximum has narrowed to a maximum of 7%, but in the grand scheme of things, depending on how much profit I can capture in that principal location, 7% tax savings could be very powerful. That's why Ireland is still a popular location, because I can do business in Ireland at 12.5% Irish tax. I have a little bit of incremental US tax to get that to 14%. I saved the delta 21. Okay. So I think the thing from a tax perspective and tax efficient supply chain planning is the tax benefit is not as big as it used to be a decade ago, but it's still powerful enough. Is it a big enough carrot for someone to restructure their entire supply chain? Probably not. But if you've already done something and you're talking about readdressing the way things have already been structured just slightly, you probably still chase this benefit. That will still be of interest. Okay, foreign holding companies are our seventh topic of outbound planning. So you always hear tax people talk about holding companies, operating companies, those types of things. A holding company is simply a corporation that is devoid of activity, and all it does is hold stock in other group companies. Okay, so you could have a foreign holding company that just holds the region. You could have a foreign holding company that owns all of your investments around the world. It depends on what you've seen, what organization you're dealing with. They can serve as the group's offshore treasury center, because that function of just holding stock makes it very conducive to being the group's banker. So it can manage the cash flow. If someone has excess cash, they may make a deposit to the holding company. If anyone in the group is needy of cash, then they can borrow from the group holding company. So you can centralize that cash function there pretty easily. Popular countries for foreign holding companies have been the Netherlands, Luxembourg, Switzerland, and Ireland. You'll notice all of those are European. Some are in the EU, some are not. Switzerland is not kind of in the EU, kind of not in the EU. They're not full-fledged members, but they are in certain things. But certainly Netherlands, Luxembourg, and Ireland are in the EU. Those have been very popular for lots of tax rules in the past, but they're very used to the holding activities for U.S. multinationals. So you'll probably see those jurisdictions mainly in organizational structures, big org charts, for historical reasons. But if there's no leakage for having them in there, you probably wouldn't change the structure just to get rid of those entities. The reason those jurisdictions are popular is because they offer low tax rates. They have good tax treaty networks. So tax treaties are not just between the United States and foreign countries, they're between foreign countries. So the Netherlands, given their kind of historical nature as a country and having lots of activities around the globe, have a very extensive tax treaty network around the world. That's good, right? It lowers withholding tax rates, it provides certainty to companies. So certainly you like to look for good treaty networks. They do not tax most dividend income. Remember when we talked about territorial regimes? You get a dividend from a country, you tax that dividend. Most of these countries do not. So the Netherlands, Luxembourg, and Switzerland just do not tax foreign dividends. Tax rate is 0. That's very conducive as you're moving cash around the group. Okay. So you'll run into foreign holding companies quite a bit. Strategic use of check-the-box elections. We talked last week about the flexibility, if I have an eligible entity, to be able to choose its U.S. tax classification. That can be very beneficial for several reasons. It's a very valuable tool in outbound tax planning. First of all, let's talk about U.S. individuals. We haven't talked about U.S. individual ownership of international investments. We typically talked about corporations. But if instead our owner is a U.S. individual, they can reduce their U.S. tax burden on the earnings of their foreign eligible entity by carefully choosing the optimal U.S. tax classification for foreign investments. So U.S. individuals are allowed preferential tax treatment. Those of you that were in individuals know that we have a 0, 15, and 20% rates for qualified dividends. Qualified dividends are not just U.S. domestic companies. They can include foreign companies to which the U.S. has a tax treaty with their country of residence. So in that instance, I could get a dividend income to a individual U.S. shareholder, right? Because corporations do not get preferential treatment on dividends. Everything's taxed at 21. We don't have a preferential tax rate for corporations. So individuals, I might be able to get a 0, 15, or 20%, depending on the taxable income level of the individual. And any individual who's owning foreign investments like this is probably in the 20% rate, because they're probably at higher income just by the nature of that investment. Losses of foreign subsidiaries treated as a corporation for for U.S. tax purposes do not flow through to the shareholder. Right? Corporations are separate taxpayers. If I have a U.S. owner of a foreign corporation, taxed as a corporation for U.S. tax purposes, any losses in that entity stay in that entity. Remember, if it was a branch or a hybrid branch where I check the box on it, where the corporation is treated as a branch for U.S. tax purposes, the losses now do flow through to the U.S. Why is that important? Because I can offset my U.S. income with the foreign loss. Okay. Now, there's lots of rules once that foreign operation turns profitable, which you have to deal with. But many times in the startup mode, it's very advantageous to have the U.S. subsidize that foreign investment by giving deductions for those startup losses. The 100% dividends received deduction for our routine earnings under the GILTI regime is only available to U.S. corporate shareholders, not individuals. Okay, so if I'm interested in that, I might want to think about a strategic use of the check the box options. Okay, our first example. Anybody want 8.5? Okay, Eli. So this is trying to set up the problem that a U.S. individual investor has with owning a foreign corporation. So this sets up the problem. The next example shows you how a strategic use of the check-the-box selection can mitigate the cost.
Betsy Ross, a U.S. citizen, owns 100% of Flagco.
So those of you that don't know, Betsy Ross is a historical figure in the United States who created our flag. So they're being cute here. She owns Flagco. Authors sometimes like to be cute. Okay.
Which is a Country H business entity that is a corporation for both U.S. and Country H tax purposes. In year one, Flagco has $1 million of taxable income. It's $400,000 of foreign income taxes,
Which is a 40% foreign tax rate. So that's higher in the foreign jurisdiction than anything you would pay in the United States, right? We don't have anything that would ever reach 40% because our corporate tax rate is only 21. This is an individual, and our highest tax rate for individuals caps out at 37%. Okay.
and distributes the entire $600,000 of earnings and profits to Betsy as a dividend. The tax treaty between the United States and Country H exempts the dividend from withholding tax. The U.S. income tax on Betsy's dividend is $120,000, 20% times $600,000, resulting in a total effective income tax rate of 52% on Flagco's $1 million of income.
So they had $1 million of income in the foreign jurisdiction, 40% tax rate, so they paid $400,000 to Flagco Country H jurisdiction, and that left $600,000 of after-tax earnings and profits that was distributed. She's an individual, and she's at the highest individual tax rate on qualified dividends. That's 20%. So she incurs an additional 120. All you do is you add the two taxes that you pay, $400,000 in Country H, $120,000 on the dividend. That gets you a whopping 52% effective tax rate on Flagco earnings. Remember our pie when we started an individual? Over half your pie is gone to taxes, right? So that's a very costly investment for this individual. Okay, you want to do year 2 down at the bottom?
Yeah. In year 2, Flagco incurs a net operating loss of $200,000. The loss does not flow through to Betsy to offset the other income on her U.S. tax because Flagco is a corporation for U.S. tax purposes.
So it's illustrating two things. Year 1, high foreign tax, high effective tax rate because I pay tax again on the dividend in the U.S. Year 2, I have a loss in the foreign jurisdiction. It's just stuck in the foreign corporation, right? It doesn't. Separate taxpayer can't flow through to the U.S. So these are the two problems we're dealing with. Okay. 8.6 is Laura? Yes?
I just have a question.
Sure.
So no matter how you look at it, I'm paying 20% tax.
Yes.
So if I was Betsy, I couldn't set up my own corporation and then I go my own American corporation and get that American corporation and invest everything back in America through that corporation and get free dividends.
So let me follow you. I thought I was following you, but then you lost me. So, are you saying Betsy set up a U.S. corporation to own this investment?
Yes.
Okay, but then you're not avoiding the problem,
That's what, yeah.
right? Because then the dividend, the $600,000 goes into a U.S. corporation. They're not allowed a preferential tax rate, so they will be taxed on the dividend income, subject to a foreign tax credit. And then if the money ultimately needs to get to Betsy, it's got to come out of the U.S. corporation. So now I'm back to the 0-15-20.
Yeah.
It's just the problem of U.S. individual ownership of corporations and paying multiple layers of tax. Good question. Okay, 8-6. So, Laura, walk us through how we can maybe save some money.
I assume that Betsy makes checks about the election is federal and disregarded, and he.
So let me pause you there. That should get very far. So remember, this is what we talked about last week. If it's an eligible entity, which means it's not the highest level of corporation in the jurisdiction, but still corporate-like, then I can make an election to treat it as being disregarded as an entity separate from Betsy in this fact pattern, which means it is a flow-through entity, it is a branch. That's why I put the dotted red box in there, is because it becomes a branch for U.S. tax purposes. Okay?
You want federal taxable or taxable income and foreign income taxes will flow through to Betsy, but the distribution will not constitute a dividend for you as taxable.
Right, because I can't pay a dividend from a branch. Right, a branch is not a separate legal entity. We're looking at this from a U.S. tax perspective, right? So Betsy and the U.S. do not see a corporation; they see a branch. They see the dotted circle. Okay.
Assuming a 37% tax rate, Betsy is now paying adding tax U.S. tax on the $1 million of foreign source taxable income, because the $400,000 of foreign tax credits would fully offset the $370,000 free credit U.S. tax.
Yeah, so that's over here. That remember, our foreign tax credit is the lesser of the foreign tax paid, which was $400,000 in country H, or the limitation, which is take the foreign source income of $1 million. You got to get back to the pre-tax income of $1 million times the 37% U.S. tax rate. That means the maximum she could take is $370,000. Well, that would be the tax she would otherwise pay in the U.S. So fully offset, so she doesn't pay any residual U.S. tax. Okay.
In year two, the $200,000 foreign loss will flow through Betsy and potentially provide her with a U.S. tax benefit.
Yeah. So in the first part, we were in example 8.5, we paid 52% effective tax rate. Here we pay a 37% effective tax rate. A 40% effective tax rate, because I still pay the $400,000 in foreign tax. I just don't pay any residual U.S. tax in the top part of both examples. In the bottom part, I get the ability, we don't know how much it's worth, but I get the ability to utilize $200,000 of a foreign loss against whatever U.S. income Betsy has.
Kind of going back to like a couple of the earlier slides from today, I was just thinking about it. What have you seen like more beneficial for like a corporation, being more like segmented by like actual business segments or more by like geographical locations? Whereas like you have like a medical device company and you separate it by like surgery side, you have the mammography division versus like United States versus Europe.
Yeah, so good question, and I'm going to answer that because in a way that you're going to run into if you start talking tax to a company versus operations to a company. Many times, the other functions in the company do not care about legal entities. Okay, operations typically doesn't care about legal entities. management many times does not care about legal entities because they view it like Connor was saying, business segments. Either I have this type of surgical product, I have this type of surgical product, I have this, so I got 3 lines of business. So they blur across legal entities and across jurisdictions, just depending on where I'm doing that in the world. But they manage it by division. And they probably get internal reports by division. Well, from a legal perspective and from a tax perspective, you have to get back to legal entities. Because nothing we've talked about in any of my tax classes you've taken with me, do we do things by division. It's by legal entities. Okay? So we need to get financial information from the organization by legal entities. Right? And accounting might not care about legal entities, right? Because they're all consolidated. They take the whole world and just put it in a big pile, eliminate intercompany transactions, and do give some segment type reporting, but they report on a global basis, right? That's the way they report it. So you again have to extract the same, you have to extract from the same location, the IT group, the information, but on a legal entity basis. Because that's where you do your tax work. So the blending and what you have to do is try to work with operations to say, okay, where are you managing risk and responsibilities for this division? But I need to know where does that reside from a legal entity perspective. So if you have management, well, who employs those in the group, right? If management for post-op surgery, whatever they would call that, is in Europe, well, what country, which legal entity in your group in that region employs those people? That's where the profit would be reported from a tax perspective. So it's really hard to have these conversations with people who do not care about legal entities because they don't understand what you're asking for. They think like you're asking for them to do a bunch of reconciliations and all these things. It's just your IT system has to be set up to where you can extract the information both ways. So it's a really difficult problem, but we get back to legal entities as to where is profits reside. And I don't think there's, to answer your original question, which one's better? I think that neither one governs the day because there's a blend amongst companies because we treat them differently for different purposes. But you got to try to balance the two. From the tax practitioner's role is to try to earn the money in the right location. That's the best that we can do. Great question. Okay. So there were 2 differences between 8.5 and 8.6. Can I minimize the tax that Betsy pays? And I can if I claim foreign tax credits with it being a branch, so I might make the check the box selection. The second thing I can do is I can get access to that year 2 loss. It will flow through if there's a check the box selection matrix back there. Okay. 8.7 is you're wrong.
So basically, US citizen owns the 100% of crypto corporation organized in the UK, which has a tax treaty with United States, and crypto earns 400,000 of income and pays 80,000 in foreign income tax.
So that means now they've dropped the facts on us. This is a low tax country. Now I'm only paying tax at 20%. Prior 2 examples, the foreign corporation was paying tax at 40%.
So because the UK has a tax treaty with the United States, so they still didn't qualify as duty yet. That means basically get to use the preferential use tax rate of 0, 15, or 20%, depending on her income level. So in this case, we assume basically is in the 20% bracket. So her US tax on the 320,000 dividend is 64,000, and then let's add it all up. 80,000 of foreign tax plus 64,000 of US tax equals the total tax of 144,000, and then dividing the total tax by the earning of 400,000, rate is 63%. And 63% is less than the top US individual tax rate of 37%.
Yes, so we're saving just slight amount, right? What the last three examples are trying to illustrate is facts matter. And what was different between this one and the prior two is we have a low tax foreign operation, so we're at 20%. And so it's trying to say, okay, I could take the double tax of the dividend and layer on an additional 20% tax in the US side on receipt of the dividend, and that's still less than if it was a flow through and it automatically was taxed at 37% to the US, right? Because I paid 20 to the UK and 17 to the US to get it up to the 37% individual tax rate, right? Okay, thank you. So what these are trying to say is it's strategic in using the use of the check-the-box selection, modeling it out, understanding what is the likely fact pattern for projections, and none of this is certain because you're estimating what tax rates will be in the future and they change on you. The UK could raise their tax rate here. The US could have a new president in 3 years. We could have a different tax rate system. So it's all doing your best efforts in trying to model and project this stuff out and trying to see if check the box will help lower your tax burden. Okay. Our ninth topic is tax havens. You guys have probably heard this term before. Used to be very popular with the U.S. multinationals, but I would think of a tax haven. When I think of a tax haven, it's a foreign location, foreign country, having the following characteristics. It either has a 0% tax rate or a very low rate of tax rate, very low rate of tax. So some jurisdictions have no tax rate. Some have very, very low. It provides confidentiality of financial and commercial information. So there might be some bank secrecy type going on, or it's very difficult for other countries in the world to extract information from this jurisdiction. Financial institutions frequently serve a disproportionate role in their economy. So it's not heavy manufacturing. Maybe big banks are down there, the big investment houses are in these locations. Again, because it's financial in nature. People are trying to put income in there without a lot of real activity. So they need financial institutions to help them do this. There is somewhat lax currency controls. So you might be dealing with lots of different currencies around the world. So you don't want to incur a lot of transactional costs and controls around dealing with multiple currencies. There's probably a lack of a wide tax treaty network. The reason being, low rate of tax, confidentiality of financial information. The United States is not going to enter a tax treaty with the location that does that. Many of the Western European countries are not going to enter into a tax treaty with locations that do that. Okay? Oftentimes, tax havens are small islands with little manufacturing or material local customer base. I think of tax havens, I think of places I like to go on vacation. Very nice, sandy, but there's not a lot of business going on there. It's rest and relaxation, right? But they have zero rates of tax because they don't rely on income to support their countries, right? It's tourism, hotel taxes. If you guys have booked a hotel in one of these locations lately, make sure you go through the all-in cost to know what it's going to cost you, because that's where they're collecting their revenue, is the tourism through the tax system. And so in the past, U.S. multinationals utilized corporations organized under these countries and tried to move income in there to enjoy the low rate of tax. Okay? That has been greatly curtailed over the years. Okay? First, remember what we had in the U.S. in anti-deferral? We have subpart F. So if you're doing certain transactions or moving certain mobile streams of income through a tax haven, the U.S. is just going to tax it if it's subpart F, right? Remember the foreign-based company sales income, if you sell across two borders and it involves a related party, you're going to have subpart F. So if you try to put subpart F in an island location, it's going to be taxed in the U.S. at 21%. So you haven't saved anything from from a tax perspective. Guilty and net CFC tested income, those regimes are not based on type of income stream or anything from a related party perspective, right? They just pick up residual income in those foreign jurisdictions and have a minimum rate of tax they put in the United States. NCTI is a 14% minimum tax rate. So if you're trying to earn income in those locations, the US, and it's not subpart F, US will at least tax it at 14%. So yes, like we just talked about earlier, you could have a 7% delta between 14% and the US rate of 21, but is that enough for you to do something like this? Global tax initiatives pushed by the Organization for Economic Cooperation and Development. We're going to talk about those in detail in a week or so. Pillars 1 and Pillar 2 that we talked about before. Pillar 2 is a global minimum tax regime. The rest of the world does not like tax havens either. So Germany's of the world, France of the world, UK, other large economies do not like their companies putting income in these zero tax jurisdictions. So there's this impetus around the globe via the OECD as the coordinating body to have a minimum rate of tax imposed on these operations. That global tax rate is 15%. The NCTI regime is 14%. We'll talk about how the U.S. Has an agreement with the OECD that 14 is close enough to 15 to count, but the rest of the world is adopting rules that have a 15% minimum tax rate. And don't underestimate this. Over the last decade plus, the public perception of tax havens and the organizational charts of publicly traded companies has soured. Okay? Companies get called in front of Congress to testify in front of Congress. Your organizational charts, in your public filings with the SEC, you list the locations of your subsidiaries. If you have Cayman Islands in there, Bermuda in there, British Virgin Islands in there, you're going to get questions on that. Because they know you're not manufacturing in those locations. 2, they know you're not selling into those locations because there's not a large customer base in those locations. So why do you have profits in there? So don't underestimate the tax, mitigating the tax benefits of doing this, weighed with the public perception that is negative towards this. CFOs and CEOs do not like to explain why they have a Bermuda company in their organizational structure. They're not good at explaining it. They're good at explaining why they have manufacturing in Mexico and why they have manufacturing in Canada, but can't really tell you what's going on in Bermuda. So that leads them to say, get rid of it. Liquidate it. I don't want to talk about it anymore. It's not providing meaningful tax savings for me to deal with the public perception. Okay? So I just wanted to introduce to you, when you hear someone talk about a tax haven, yes, you can still see that. There's some remnants of it in org charts, but it is greatly curtailed for these factors we just talked about. Okay, let's move on to the financial reporting implications for U.S. outbound investment in foreign jurisdictions. So the globalization of business has increased the importance of understanding how a U.S. corporation's foreign operations affect its ETR reported in its financial statement. Remember, ETR, dividing book tax expense by your pre-tax book income, simple calculation, is the common metric used to compare the tax efficiency of competing corporations. So publicly traded companies, when the CFO presents the quarterly results, one of the items that might come up is your effective tax rate relative to your peers. If you are outside of the norm, either higher or lower, you might get a question on that. Why is your ETR high for your segment? Why is your ETR significantly lower than the segment in which you're operating? That person, whoever is leading that discussion, needs to have a response to that. Okay? Part of it might be what locations you're doing business in outside the United States. Okay? Given the U.S. income tax rate is 21%, if you're in a high tax foreign country, all other things being equal, you'd expect your global effective tax rate to be higher than 21. right? Because you're gonna blend all those foreign earnings and foreign taxes that you pay around the world. If you have foreign operations that are above 21, the US is at 21, your global ETR is gonna be higher than 21. So it could be as simple as that. Oh, we have operations in Germany. We have operations in France. They're higher than 21, so our effective tax rate is 25. Right? Conversely, if you have operations in a low-tax foreign country, so if you have a significant amount of operations in Ireland, like your Apple, you go to Dublin, you go down to the business district, you'll see Apple on sides of buildings. Apple has a significant presence, significant employee base in Ireland. They pay tax at lower than 21% in that location. That might pull their effective tax rate below 21. So if they got a question as to why is your effective tax rate 18% when you're a U.S. corporation, it's because they run their non-U.S. operations out of Ireland. The profits there are taxed at less than 21%. If you are operating in a high tax country, then that can increase, like we just talked about, your ETR above the U.S. tax rate of 21. But that would give rise, remember back to our foreign tax credits, that should give rise to excess foreign tax credits, right? You pay tax in a foreign country. We just went through the 2 examples where we paid tax in a 40% country. Then if I claim a credit in the United States, I already paid tax at higher than 21. I should have excess foreign tax credits, meaning I paid more foreign tax than I can currently credit in the United States because I'm limited to foreign source income times 21%. So excess FTCs resulting from operating in those high tax foreign countries can increase the U.S.'s effective tax rate to the extent those FTCs cannot be used in the carry back or carry forward years. Remember, if I have excess credits, I get to go back 1 year and forward 10 years. And I add those credits to the FTC limitation in those years to see if I have room to utilize those credits in that 11-year window. Right? The U.S. is trying to give me a wide range of time to utilize credits because if I can't utilize the credits, I pay double tax. Right? So, if, this is a big if those FTCs can be used in the carry back or carry forward years, your deferred tax accounting, we went through this for those of you that are in business entities, may result in a reduction to book tax expense, and thus excess FTCs may have no impact on your company's ETR. Pay foreign tax in the foreign country higher than 21%. If you can utilize them in the carry back, carry forward period, you are going to set up a deferred tax asset. You debit deferred tax assets, right? Because it's an asset balance. Your credit is the income statement. You're accrediting deferred tax expense. When you credit an expense, you're lowering the expense. That lowers your effective tax rate. You can credit all of your excess foreign tax credits, that will get you back to 21%. Okay? So, the analyst call could go something like this. Oh, I do business in France and Germany. That's why my effective tax rate is greater than 21. A smart analyst might say, yeah, but can't you utilize those credits? The answer would have to be, no, I can't utilize those credits if I have a high effective tax rate because I don't project I can use those in the 11-year carry forward window. And you wouldn't be able to if your facts don't change. If Germany and France stay high tax and the U.S. stays at 21 and your business doesn't change, you're not going to ever be able to get those credits because you're going to have excess credits every year, right? Or if you could record this journal entry here, then you wouldn't have to explain why you're in an excess credit position because it wouldn't be visible because your effective tax rate would drift back towards 21% by virtue of this journal entry that would reduce your tax expense, your book tax. Okay. If I'm operating instead in a low tax foreign country, right? Ireland's 12.5%, Switzerland, I can get a ruling about 10%. Finland is another low tax jurisdiction. And I'm just calling low and high based on US is 21%, so it's all relative to 21%. So these jurisdictions are below 21%. So recall that the profits of a foreign subsidiary are also taxed in the United States based on the following hierarchy. Subpart F, first, and that's at 21%, right? Because if I do one of those transactions or I have one of those income streams in a foreign subsidiary, the US taxes it again at 21% with an FTC, prevent double taxation or mitigate double taxation. I have GILTI for 18 to 25 and NCTI beginning in 26, also with FTCs, but that's basically a 14% tax rate for NCTI. So anything below 14% in a foreign country, I'm moving it up to 14. Anything above 14, I won't be able to credit in the United States, and that will be excess credits. If I can get through those regimes, then I have 100% dividends received deduction, meaning that the dividend is not taxed in the United States. It's not taxed, I don't have a risk of double taxation, so no FTC allowed. Okay. To the extent not routine non-subpart F undistributed earnings are generated in low tax countries in 25, such earnings do not incur incremental residual U.S. tax due to the applicability of the 100% dividends received deduction, which can give rise to permanent tax savings. If I can earn money in a lower tax jurisdiction and navigate subpart F, GILTI, and NCTI, then I get to keep the benefit of the lower tax relative to 21%. That's the trick when I'm doing business in low tax jurisdictions, something below 21 is, can I keep the U.S. from taxing it up to 21? If I can, then I can have a lower effective tax rate. The analyst call might go, why is your effective tax rate below 21? Oh, remember, we have significant operations in Ireland. That tax rate is at 12.5%. NCTI increases it to 14, but I don't pay anything higher than 14. 21 in the United States, that's why my effective tax rate is low. Again, that's the education that will have to go on to the CFO or whoever's running the analyst call, so they have a response to that. Okay, let's start the example, the comprehensive example. Okay, let's level set on facts, because all these build on each other. When you go back and you're reviewing this for the exam, try to look at all the examples in the same sitting so that you can see how they compare and contrast to each other. So we have a U.S. company, because this is outbound. It plans to locate the investment for a new factory in 2 locations. Country L for low tax, country H for high tax. So we're going to be in a modeling scenario where the business people has a tax representative in the conference room and they're kicking around, hey, should we do this in country L or country H? And you're going to be trying to put forth your perspective on this. You're going to be involved in the modeling, trying to see if you can influence where the decision is made. So Forco is 100% foreign-owned corporate subsidiary of USACO, and it will own and operate the new factory. So the question is where do we organize Forco? Is it going to be in country L or country H? Forco is expected to earn $10 million of taxable income, all from active foreign manufacturing, such that subpart F income will not apply. Remember subpart F income, if I had buy, sell between countries across 2 borders related party, I have a problem. One of the exceptions to that is if that base company was manufacturing. If they manufacture, that takes you out of subpart F because you're not moving profit inappropriately through the system. Someone's actually manufacturing. So we're going to assume Forco, even though he might be involved in some buy-sell stuff with a related party, is manufacturing in the middle of that transaction that extracts ourselves from subpart F. Forco's rate of foreign tax, we're going to say, is either 15 or 30, is greater than the 14% minimum tax of the NCTI regime, such that those earnings are not expected to result in incremental U.S. taxation either when earned or distributed. Okay, so this is important. It's low tax or high tax, 15% or 30 in country L or country H. That's 21. The U.S. tax rate's in the middle of that, but the low tax of 15% is still above my NCTI minimum tax of 14%. meaning that the US won't come in, even if it's net CFC tested income in 26 and forward, will not impose additional incremental US taxes. Okay, so I get to bank the savings between 15% in the foreign country and 21 in the United States. If my option was to otherwise build this facility in the United States, pay tax at 21. And to simplify things, USA code does not derive any earnings but for the earnings we're talking about here. The 10 million from the new investment. The worldwide ETR, which is one of the things that the deal model is going to be premised on here, is on USA code and foreco earnings will vary significantly in the following cases depending on several factors, including whether it's in a high or low tax jurisdiction, right? Whether foreco distributes its dividends to the U.S., and if so, whether in the form of dividends, interest, or royalties. So this is your cash, right? We can't just look at where you earn the money and where you file and pay taxes. Always look through, well, what are you going to do with the cash? That's when you're in the meeting, you're talking to the business people. Are we going to continue to reinvest the earnings in this business? Are we going to plan to make distributions to the U.S.? You're going to hear different answers. Well, if we are going to make distributions in the U.S., how are we going to do that? Are we going to do that with dividends? Are we going to do that with interest? Are we going to do that with royalties? Remember, if it's going to be on interest, then I have to capitalize the entity with debt in part so that it can actually have interest that it owes to the U.S. If I want to do royalties, then I have to say, is that factually accurate? Do I have intellectual property that I'm going to license to the foreign jurisdiction? And then the applicability of the favorable tax treaty withholding rates on dividends, interest, and royalty payments from foreco to USA co. So, is country L or country H a treaty partner with the United States on a tax treaty? That will impact my movement of my cash and my tax rates. All trying to hone in on what's my worldwide effective tax rate on a fully repatriated basis. Assuming whatever the business is not going to use to reinvest that's extra cash, I factor that into this. That's what I mean on a fully repatriated basis. Okay? All right. Case one is
So in case one, foreco is located in country L, which has a 50% corporate income tax rate, and critically, foreco does not distribute any dividends back to USA co, so the earnings just stay in the foreco subsidiary.
Yeah, so if I was in that meeting, I would say, are you sure? I mean, are you just saying for 2 years, 5 years? How long is that horizon? But just pressure testing that statement that I usually an investor wants to see some cash out of the system. So to say there's never a dividend paid is a bold statement, but that's the fact we're here. So there's no dividend being paid here. So walk us through the calculation.
So foreco earns 10 million and pays 15% in local tax. That's 1.5 million in foreign income tax. Since no dividend is paid, so there's no foreign withholding tax because nothing is being sent back to the United States. And there's no US tax because USA co hasn't received anything to report. So the total worldwide tax is just 1.5 million. And divided by the 10 million of earnings, the worldwide effective tax rate would be only 15%.
Yes. And so I put in the box to the right just to make sure, why is there no U.S. tax in this situation, right? This is likely to be net CFC. I'm thinking about this in a planning perspective, so we're in 26, so if we were sitting in this meeting, talking about going forward, so that's the NCTI regime, and that regime is looking for earnings that have been taxed at 14% or lower. So the U.S. is only going to incur tax on foreign earnings that have not been subject to a rate of tax of 14%. This rate of tax is 15%, so we should have a 0 in the U.S. tax column. And plus, as you're wrong, saying we don't have a dividend, so I don't have any tax on the dividend either. So this is just setting us up as a base case. If I make money in a low tax country and I do not pay a dividend, low tax relative to 21, but above the 14, so that's important, then my effective tax rate stays at the foreign rate of tax, 15%, right? And so I can lower my worldwide effective tax rate in these back brackets. Operate in a low tax, but above 14%, don't pay a dividend, and not have subpart F income. Right? So that's important too. This assumes there's not subpart F income. Subpart F income is taxed at 21% subject to a credit. So I would have bumped that 1.5 million. I would add a number here on the U.S. tax line. Okay, case 2 is Laura. Anybody want case 2?
So case 2 is about low tax foreign country. Within the tax treaty, the USA Co. locates foreign company in country L in the tax treaty with the US that provides for 18% tax rate withholding on dividends. Foreign company distributes half of its after-tax earnings as dividends.
So I'm in the same country. Country L is case 1, 15%. But here I'm going to pay a dividend. I'm going to pay a dividend of half of my after-tax earnings, meaning the other half is going to be reinvested. And that half that's distributed, I have a tax treaty, but it only lowers the rate of withholding to 10% on that. So walk us through this.
So you start off, I guess there's other tax. Worldwide effective tax rate rises to 19.25% from 50% in case 1. No FTC is allowed due to the 100% dividend receipt deduction allowed by US income. So we start off with foreign companies' taxable income, which is $10 million, and multiply it by the 15% that we got as the foreign income tax.
So this is the way I always like to build these things up from the bottom up, because you're always going to pay tax in the foreign country, right? So we have 1.5, just like the first example. That doesn't change by virtue of your dividend policy or presence of a tax treaty. That's just you're earning money in a 15% jurisdiction. Okay?
So you subtract the 1.5 from the 10 million in foreclosed taxable income, and you get to a foreclosed after-tax earnings of 8.5 million. Then you have the percentage that is repatriated through dividends, which is about 50%. With that, and it gets you down to a dividend distribution of 4.25 million. Then you have to include the withholding tax rate per treaty, which is about 10%, and that knocks your number down to 425,000 country L withholding tax.
Yep.
Then we move on to U.S. tax on repatriated earnings. You start with a dividend from Forco, which we calculated as 4,250,000, which is 8.5 multiplied by 50%. Subtract the dividends received deduction, so we get the full deduction, the full 4.250.
That's because of the same fact pattern we dealt with in the first case, is because it is a lower tax, but it's above the 14%, meaning that I would get a full foreign tax credit against the NCT inclusion. So I won't pay any. What's going on here? There's a lot going on, so I tried to explain that in the box. When earned, the income is not being taxed on the NCTI inclusion because it's above 14%. Which means when it's distributed, it's not taxed either. That's getting the 100% dividends received deduction. Again, the U.S. feels like 15 is high enough for purposes of our prospective NCTI. Okay.
So we have $0 that we have to pay to the government for our taxes, multiply that by 12%. Your total taxes is the 1.5 that you get from the country L income tax, the very first step, plus your 425,000, which is your country L withholding tax. So you're paying $1,925,000 to country L taxes, and then that gives you a worldwide effective tax rate of 19.25%, which is the amount of taxes you're paying in country L over the amount of income that you generated.
Yeah. So what I showed here, I put green on an arrow next to the 15% in case 1. That's the lowest I can get, right? Because I'm earning money, and this is probably the perfect scenario. I'm earning money in a 15% jurisdiction, and that's all I incur because I'm reinvesting in that jurisdiction. Case 2 I put as yellow because now I'm starting to get a little bit higher of 15. And that's driven because I got a dividend policy here of I'm going to distribute half of my after-tax earnings, and it incurs a 10% withholding tax. So that 425 is what pulls my effective tax rate up to 19.25. Still below 21, but from a tax perspective, not as powerful. This is where the tax person may not get the result that they want. Like you'd like to be in case 1 at 15%, they're causing you to be in case 2, 19.25. That's all driven by the dividend policy, which you are not going to have any control over, right? Business is going to say, I don't need all of that money in that country. I want to distribute some and use it elsewhere in my business. There's a cost to that. Okay, case 3 is.
Okay, so USACO locates Puerto in country L, which does not have a tax treaty with the US and imposes a 30% rate of withholding on dividends under domestic country L law. Puerto distributes half of its net income as a dividend. So here we have USACO. Sorry, I was wrong. Okay, I was reading off the right. Okay, and basically it goes from that $4.25 billion dividend to that 1.275 withholding tax if you see it go from that Florida code to the USA code. And then kind of what you see down here, you have that 4.250 million and then that 2.775 million.
Yeah, so we have the same local tax, right?
Right.
15% at the beginning. Same dividend policy as what Gray went through. Delta is, I don't have a tax treaty with this country, right? So this is as a tax person, you'd say, oh, it's really important if country L is in a treaty country or not, because case 2, I only go to 19.25. Case 3, same dividend policy, goes to 27.75, which is way above 21. And that's all because of the 30% withholding, which drives up my withholding tax.
Right.
Significantly, 20% higher. And my same residual U.S. tax is 0 because the income tax rate is higher than 14%. Okay. So you just see the kind of the deltas that you're going to be exploring on these things. And if you were in the fact pattern and you did, somebody said country L and you looked it up and country L does not have a tax treaty with the U.S., you'd say, what's our dividend policy? Wow, we're going to get hit with 30% tax coming off every dollar of income that we distribute out of the country. Okay, case 4 is Meta.
So in this case, Worko is located in Country Beach, which has a 30% corporate income tax rate, and they don't distribute in a dividend, so their income is still 10 million and taxed at 30%. Their foreign income taxes are 3 million. And so there is no withholding tax, foreign withholding tax, because no dividends are being distributed. And then because that 30% is a high tax country, which is higher than that 14% minimum, there are also no U.S. taxes, so the only worldwide tax would be the 3 million at 30%.
Yeah, so I put red there because that's higher than 21. So again, think of the analyst call when someone says, why is your effective tax rate higher than 21? Well, we made an investment in high tax country for our new factory, and that rate is 30%, so that pulled up the global effective tax rate above 31, or above 21. And I put here, it's easy to get lost in, well, this seems dumb, why would you do that? Well, there could very well be good non-tax reasons to operate in high-tax foreign country, right? Maybe the raw materials are in the ground there, and that's what you need. Or maybe your best customer is right down the street, so you want to build the heavy piece of equipment and sell it right down the street, and you don't have to transport it halfway around the world. So there could be lots of other reasons. But for that to be an efficient investment, the business needs to know that they got to overcome a 30% tax rate, right? So those other efficiencies have to help, lower the overall cost of this investment. But there may be non-tax reasons why. Okay, case 5 is open. Anybody want it? Genevieve.
This example, USA co-locates Worko in country H, which is a tax treaty with the US that provides for a 10% rate Orca distributes half of its net income as dividend. They had 3.5 million to dividend last with 10% withholding tax, which paid $350,000. So as you can see here, the foreign income is 10 million with 3% tax rate, $3 million income tax. We found their after-tax earnings by doing their taxable income minus their income tax, which was 7 million, and then we times that. She got 3.5 million times that 10% of that tax rate.
So not only do we have a 30% income tax rate, but we're getting dinged at 10% coming out of the country. So now we're dealing with a very high tax investment here. But again, certainly reasons why they might do this, but now we're starting to add the tax burden.
After the federal taxes, we did the income tax plus the withholding tax. So we got the worldwide effective tax rate.
Now we're way above the 21% effective tax rate. Again, could be reasons why we would do this investment irrespective of the tax cost, but they have to be even better to make this work. And the analyst call would say, I'm operating in a 30% jurisdiction and I have a 10% withholding tax rate and I intend to make dividends out of this investment. That's going to give me the 33.5%. Right? Okay. P6. Anyone? High tax foreign country, we pay a dividend again. Now we're in the worst of the worst we could be in. Now we don't even have a tax treaty with this high tax country. So the USACO locates Forco in country H, pay 30% tax, does not have a tax treaty, and we get a 30% rate of withholding on dividends under, that should be country H law, not country L law. Forco distributes half of its dividend as a dividend again, so half of that dividend is going to be half of those after-tax earnings is going to be 3.5 million, and that's going to incur $1,050,000 of withholding tax. So my bottom-up approach, I've got the same 10 million taxed at 30%, so it's a $3 million local country income tax. My after-tax dividend distribution is 50%, 3.5 million. Now I get a big whopping withholding tax of 30%. That's my $1,050,000. Here again, no incremental U.S. tax when earned because the tax rate is higher than 14%. Net CFC tested income is a minimum income tax regime on anti-deferral, so I don't tax it when earned. I don't tax it when dividended. No residual U.S. tax here. So my foreign taxes, or my global taxes, $3 million of income tax and $1,050,000 of withholding tax. Now I got 40.5% effective tax rate here. Think of the pie again, right? I'm losing more of the pie by choosing to do it in these facts compared to some of those earlier examples. That's where the efficiencies that you're gaining by choosing to do it in this jurisdiction have to be that much more impactful for you to bear the cost here to try to get the pie even bigger. Okay, page 7. Now we got high tax. Now we're going to repatriate in a deductible form of payment. Remember, dividends are not deductible and arriving at your taxable income anywhere in the world. So dividends paid out of any of the countries is not deductible in that top part of that calculation. Here they will be. I'm going to take an interest deduction or royalty deduction, and I got a tax treaty because those flows also may or may not attract withholding tax. I'm going to look at the tax treaty, and that's going to give me a lower rate of withholding tax here. So I'm going to operate in country H, which is 30%. It has a tax treaty with the U.S. that provides a 0% rate of withholding on interest and royalties. Forco pays half of its $10 million pre-tax net income as interest and royalties to the U.S. Okay, so I'm operating at 30%. I'm going to pay a deductible payment out of that jurisdiction to the United States that will be taxed at 21%. Right? The NCTI regime does not apply to dividend or to interest and royalty income in the United States. That's just taxable income. Okay, and I'm going $3 million, and the facts, a $3 million interest payment, a $3 million royalty payment. Okay. So now my first section gets a little more stuff going on there because I have a $10 million of earnings before interest and royalties. I deduct the interest payment, I deduct the royalty payment I'm paying to the US. Those have to meet the transfer pricing requirements, meaning that the interest has to be on valid debt. The interest rate has to be arm's length. What would a third party charge, what would the US charge a third party in making a similar loan? So, and the royalties have to be based on the use of intellectual property that the United States owns that is licensed to Forco, and the rate of the royalty has to be arm's length. What would USA co-charge a third party from a rate perspective? So assuming those are there, I can knock my taxable income in the foreign jurisdiction down to $5 million, still taxed at 30%, but I've cut my foreign tax burden down to 1.5 million. I do not have any withholding taxes coming out on that interest and royalty because the tax treaty, I looked at it and it told me I had 0% withholding tax rates. Now the US has 5 million of income because the payment has to go somewhere. Payment of interest and royalties deductible but includable at the US company level. So I got 5 million total of taxable income times 21, so I incur 1,050,000 of US tax. I don't get a foreign tax credit on interest and royalty income, right? I'm just taxed on those. And so my US tax is 1,050,000, so my total taxes are 1,500,000 country H, 0 withholding tax, and 1.5 million on the income that I shifted from country H to the United States. So now I'm down to 25.5% global effective tax rate. What I've effectively done here, I put it in this box, is I've moved in $5 million of cumulative income from being taxed at 30% to being taxed at 21%. By taking the money out as a deduction from the 30% subsidiary jurisdiction up to the US at 21%. That is what lowers, it keeps this lower. Instead of repatriating with a dividend that is not deductible and incurs withholding tax, now I am repatriating with a deductible expense and have 0% withholding tax. So if your facts lend itself to this, you could say, hey, as we put money in the foreign jurisdiction to build this new facility, can I lend some of the money to it? That would give me the fact pattern to pay interest back to the United States. I might want to do that if my dividend has a high withholding tax rate. You might ask, do we have intellectual property that that the foreign subsidiary could use? Maybe our manufacturing know-how, our processes, right? Maybe I can license those in. Again, I can compensate the US for doing that by a deductible payment per royalty. Again, all modeling. You can imagine now this is an Excel file with multiple tabs of every alternative that you're doing, running these different scenarios. And I put that as red arrow because still above 21% on the analyst call, but much less than some of the earlier examples, which were higher in the 30s and 40s. Okay. All right, we'll pick up with case 8 on Wednesday, and we will finish this and go into chapter 12. Chapter 12, when we talk about transfer pricing, and we've touched on it a few times, but we're going to go through it in more detail in chapter 12. Okay? Thank you. Those of you that volunteer, please put your name on the Excel file so you get credit. I don't have to that. So if you want to sit down and talk about it, just send me a note and then we'll get together. Yeah. Everybody sign in?
No, I'm just taking a break. Class right after.